I want to welcome everyone to the World Affairs Council of Greater Houston, as today we continue bringing you global perspectives and local conversations. I'm Marianne Maldonado. It's an honor to have joining me today Filipe Barbosa and Nikhil Patel as our guests for a conversation on energy transition, how digital is reshaping the workforce, the impacts of COVID here and abroad, and who knows what else we'll talk about. But first, let me introduce to you our guests. Filipe Barbosa is a senior partner in the Houston office of McKinsey & Company, with over 2 decades of experience at the firm. His work focuses on energy, oil and gas, petrochemicals, engineering and construction, and the mining and metals sector. Locally, his work also includes helping multiple nonprofits all across the Houston area, including the Texas Medical Center and the Houston Livestock Show and Rodeo. His expertise is in the areas of performance transformation, growth, strategy, capital projects, merger integrations, and organizational design. Filipe leads McKinsey's oil and gas knowledge efforts globally, as well as their service line in oil and gas sustainability. He co-founded and has led globally McKinsey's capital projects and infrastructure practice, serving clients on mega projects extensively across many industries. And he is one of the lead authors of the McKinsey Global Institute's report titled Reinventing Construction, A Route to Higher Productivity. He is also part of McKinsey's Global Energy and Materials Leadership and has co-authored articles and research on global strategic shaping forces, strategy formation, and construction productivity. Also joining our conversation today is Nikhil Patel, a partner at McKinsey's Global Energy and Materials, Digital and Economic Development Practices. In energy, Nikhil serves renewables, power, oil and gas, and chemicals clients. In digital, he supports clients on the full spectrum of capturing business value from digital, and from digital strategy and roadmap development across advanced analytics, process digitalization, and automation to digital execution and change management at scale. And in economic development, he has supported diverse regions across North America on sector development, workforce development, and reskilling. It is indeed our honor to have both of you joining us. Gentlemen, thank you.
Thank you.
Thank you. Thanks for the opportunity. Looking forward to it.
Absolutely. I know McKinsey is involved in so many amazing industry forecasts and is all around the world, but let's bring it down to kind of realism for us here in Houston. The pandemic has affected us in so many different ways. And from McKinsey's vantage point, maybe you could start out, Filipe, with telling us what areas have you seen the greatest impact?
Yeah, I think this is a topic near and dear to all of our hearts. I mean, firstly, COVID has been a real human challenge and in many ways a tragedy, right? I think the economic impact on many sectors of society, and even the more subtle long-term impacts, the lost school months and years and so forth and so on. We're going to feel that for a long time, right? However, I also think it was an incredible catalyst for a lot of events, and it challenged all of us. How do we operate and how do we survive in just extraordinary in an extraordinary environment. So some observations. I mean, I think first of all for Houston, the shape of what's affected us has been different and our response has been different. I can say a few things. Firstly, as usual, I think the Houston community got together and just did a really great job. Behind the scenes, there were so many multilateral efforts, of folks who collaborate, who, should not naturally collaborate. So we had, multiple hospital systems, across public and private healthcare, where from the supply chain through to the CEO level, people working every day, and collaborating to make sure, we didn't run out of equipment, we didn't run out of space, we didn't run out of, skilled nurses and doctors. And I think we can be very proud, and I'd say, Houston did, spectacularly on that front. there was also a lot of collaboration that, on different institutions, elected authorities, as well as business together with healthcare. So I think that was very special. The shape was different. If I just contrast New York to Houston, let's look at one simple metric. If we look at mobility, if we look at total mobility versus the January baseline, New York was down 72% at the peak of this, and today is still down 51%. Houston was down 49% at the peak, still down 26%, right? So, Houston recovered faster, went in shallower, and it's partly around how we organize it, it's partly around our beliefs and so on, but it's still very significant. I would say, we learned some just fascinating insights, because this accelerated the gig economy, this accelerated digital in remarkable ways, right? So what did we learn? I think every group, including our own, got together at the business and said, what's the worst case scenario, right? We did not know we could conduct business, right? Houston in particular, the way the oil and gas and hydrocarbons industry was able to operate safely under these environments is just spectacular, whether it's, managing projects in Eurasia with 40,000 people, or operating our refineries or offshore platforms. I think it was a real success, and I think that they surprised themselves, just on how well they did it, right? And the sacrifices, that individuals gave, in terms of, isolating themselves before they go in an oil and gas platform. So I think the big surprise is how well big chunks of the economy continue to perform. In terms of productivity, when we do surveys, it's fascinating. 10% of people say actually their productivity went down, period. Right? But a full 50% say their productivity went up. Now, it comes at a cost. It comes at a psychological cost. It comes at, weariness cost. It comes at a lot of personal and family sacrifice. But 50% of people said they experienced a productivity increase. It's quite remarkable. When employees are surveyed and said, would you like to work remotely, almost a similar number, 40, 50% say in some form or fashion, maybe not full time, they value that, right? So there's no doubt this is going to accelerate, the gig economy. What was interesting, one negative thing is when we look at collaboration and effectiveness of collaboration, we saw that go down by 20 to 25%. The amount of time you need to get effective collaboration, we measured as going up by 20 to 25%. I think one of the tricks people who have not seen this decline as much is, what we call almost like micro transactions, micro meetings, right? The 5-minute one-on-one or one-on-two meetings. In some ways, it takes over the human collision of bumping each other outside of a meeting room or at the coffee station, right? But it's actually needed for collaboration. It's needed for networking and innovation. And that is something that net we saw a loss of. And there are interesting tricks to do this. So that's pretty fascinating as well. When we survey executives and companies, we would put them into kind of three, and I'm going to actually pull up some quotes here, but we kind of put them into three groups, right? The one is the groups that say, look, we are returners, right? We're going to return to work. Some of the banks went out there, and some of the tech companies out there said, like, we cannot innovate at the rate that we need to without, physical collaboration, right? And so there are definitely returners, right? And then a big chunk of them. Then we say there's the hybridizers, right? And I think that's the vast majority. They say, look, there's benefits to both, and we're going to figure out a way of making this, hybrid. And then there's a few that are the retoolers that say we're all in, right? And we're going to fundamentally change things, right? And it can be, I've seen, a company in Houston say our whole head office is going to be 2 to 3 days a week on site. And, we're going to have flexible seating, right? That's quite a big deal. Other people are saying my whole business can go online. But that's not the majority. So really interesting, positions of organizations. Finally, what's the impact on oil and gas, right? And demand. In the short term, we just know that there was unprecedented demand destruction, right? And it was just remarkable and it put enormous stress on, all of us. we do see it bouncing back, very quickly. And by next year, we'll be back to that level. Obviously aviation, fuel and so on, has taken a while and will take a while to recover. We do think in the greater scheme of things, the demand destruction from an acceleration of the way we work will probably be in the order of about 2 million barrels a day by 2035. So is that big? Yes, it's kind of 2% of global demand. But in the greater scheme of things, it's, 5-6 times less than some of the more, some of the things that are driving growth, like, petrochemicals and the developing world, and things that are taking away from growth, like electrification of vehicles and fuel efficiency and so forth. So it's there, but it's not going to be, a fundamental factor. So yeah, it's been a, fascinating, and I think we're still experimentally learning with.
Nikhil, how about you? Same question, maybe from a different angle. What have you seen has been the greatest impacts or changes
from the pandemic?
Yeah.
And this might link to what we get to later in the discussion around skills and competitiveness. But, if you look at the profile of the people dislocated by the pandemic, about a little less than a year ago, the numbers were as high as 20 million, depending on what source you looked at. Today, they're still as high as about 9 million across the US who are unemployed. And out of those, 2/3 of them are people who came from lower wage work and don't have a 4-year degree. So they have a wealth of experience, they have a wealth of skills, but they're going to have to get back to employment and want to get back to employment in a situation where it's going to be fiercely competitive. There are many barriers to them getting back. And a lot of the jobs that they went out of are not necessarily coming back. There's a large chunk of those jobs are permanent job losses. And so I think there's a real question for us. Everything that Filipe described about Houston's response to the pandemic, it really, I think, hopefully for the folks that are, listening to the discussion, it resonates how people came together and made some smart choices to be able to manage the course of the thing. But if I take a national view and I say, what does this mean more broadly? There is a real imperative we need to think about for a variety of reasons of how do we expand the employment opportunities, both in the near term as a response to the pandemic, and then use that as an opportunity to lay the foundation for the long term for people to tap into their skills and get opportunities based on skills and experience. That's going to take a really big push from all sorts of stakeholders in society, whether it's businesses, government, training providers, community organizations, and a lot of the kind of creativity that we as Americans have mobilized in these special times. And I think this is one of the areas where the pandemic has really created a need for it.
Yeah. And Marianne, just coming back to, I said I'd read a few fascinating quotes, and then I want to take a kind of a global perspective. Here's a few quotes, and all from, tech companies in the US. So Mark Zuckerberg, Facebook, at least some work will remain remote indefinitely. Sundar Pichai at Alphabet, a flexible work model will lead to greater productivity, collaboration, and well-being. Then you listen to Satya Nadella at Microsoft. Staring into a screen lulls you into a stupor. Casual interactions just don't happen anymore, right? So, I think these are all facets of the same thing. I think internationally, when you look in a global perspective, we had a really important point. You're getting two speeds of emergence in the world, right? And this virus keeps on throwing us curveballs, right? No one ever knows the full answer. So, we have some of these economies that were never really affected dramatically, or were able to, because of their geographic isolation or whatever, just essentially not have COVID, right? In some ways, like New Zealand and Australia and several Asian countries. And then you've got this bunch of really big important economies now seeing daylight, right? The UK, Israel, the US, right? Driven both by policy, but also by availability of vaccines, right? And so you're seeing, true daylight, and people are saying, I can see that in a few months, life might become basically normal. And then you're seeing this dramatic acceleration that we expected actually to happen much earlier that didn't, right? In Brazil, in India, and so forth, which is, quite frightening. And we don't know the end game on that, right? It might just be a phase lag, and they might just be following behind us, and they're developing their own vaccination programs. And luckily, India has enormous capability on that. But we also don't know the role that variants and so on are playing, right? So this movie is not finished, and right now we have a real two-speed emergence of the global economy.
I want to move our conversation over to kind of the impact on energy, oil and gas, infrastructure, construction, production. What have you seen of the biggest impacts in those areas?
I can't speak for all areas, but I just think different parts of the economy have just reacted, very differently, right? Private equity is going through a boom, right? Oil and gas, if you're in oil and gas, or in hospitality, or in airlines, it's terrible, right? Even just within oil and gas, it's very different where you are, right? Today, if you're an upstream company and you've got good assets, the oil price isn't bad and you're seeing cash, right? If you are in the services industry where there's dramatic overcapacity, it might be 5 or 10 years before pricing will get back to a point where you can even make economic returns. So, in healthcare, some parts of that value chain have had, dramatic expansion. But if you're a provider, while you're looking after all these folks and making capacity in your, med surge and your IC units, you weren't doing electives, and that's what, is your funding. And so, they've had a tough time, right? So even industries we would expect not to be affected have been dramatically affected, right? So, I just think it's a very different shape depending where you are, and even within the value chain. I don't know, Nikhil, if you want to add to that.
Yeah, I might add 2 things, but then Filipe, tell me if you viscerally disagree. We'll air our dirty laundry publicly. So I think if I just think about the energy piece of the puzzle, not across sectors, but just energy, I might go back to something Filipe said at the beginning about how, for example, the pandemic effect on oil and gas demand was 2%, which is relative. It's meaningful, but it's relative.
Long term.
Yeah, long term. Which is meaningful, but small relative to the other things that are either headwinds or tailwinds for demand and for supply. And I think similarly, if you look at power, I don't know, if we look across our clients, I don't know that there was a really deep, big effect that's going to have long-term repercussions for utilities, renewables, developers, et cetera, from a market basis. So when I look at coming out of this past year of pandemic, what would really be driving changes going forward, it actually seems more like policy driven than it is market driven. So for example, what are the types of things that state and federal government are prioritizing for spending as we come out, get into recovery? To what extent does that shape infrastructure? To what does that shape extent does that shape opportunities and constraints on energy? So I think it's more policy driven. The other thought I might lob out there, which might be strange, counterintuitive, I don't know, but just an observation. We have seen over the past year, I think, an extraordinary increase of attention, if not commitment, to the idea that investment around energy transition is important and real. And this is across sectors. So it's not the usual suspects, but when we look across energy and materials, whether it's oil and gas, chemicals, power, basic materials, executives across companies are taking it seriously. Now they're thinking about it in different ways, right? Depending on what kind of business they have, where do they play on the cost curve, whatever it may be, what geography they're in. But they're taking it seriously as a priority at the top levels of the company in a way that I haven't observed pre-pandemic. And I think we still have to untangle why, but it feels like a definite trend. I don't know, Filipe, if you would disagree with that or share the notion.
No, for sure.
Well, you touched on the topic that we want to go into next. With the current administration, I think there's a general talk about climate change, the impacts. I want to discuss a little bit more of the energy transition topic. For the general layperson, business layperson or consumer, how would you define energy transition? Many of us know it, think we know it here in Houston, but how do you see this?
Look, this is an incredible topic, and it's a topic that McKinsey and our clients have just spent an enormous amount of, effort and, millions of research hours trying to understand. And ultimately, because there's a lot of policy and technology uncertainty here, no one knows the end game. But, first of all, define it as, a confluence of, 2 or 3 things. I think there's a societal awareness, more so in the youth than others, but there's a societal awareness that, humans are having an impact on this planet, on a great scale, not just global warming or carbon or deforestation. It's just, there is a zeitgeist that is, people are saying this is fundamental, right? So I think, first of all, there's a societal pressure, regardless of the science, right? It's just, it is what it is. Secondly, to Nikhil's point, the topic of global warming and carbon and methane emissions is now, an unstoppable force, right? It is on the agenda of every policymaker, of every government, and of every CEO in the world, and of every investor in the world. And it's an unstoppable train, and society is figuring out the best way of dealing with this, right? And it's very, very complicated because, it's very easy to say, look, we have the technological know-how, to decarbonize, let's go do it. But if you're a developing country whose primary source of energy is coal or biomass, there's just no way you're just going to do it tomorrow because, you have an economic development job of your people to do, and expensive energy is a no-no, right? So the second thing we have to balance is availability of energy, reliability of energy, and cost of energy, right? But ultimately, and there is an unstoppable force. We can debate about the pace and a desire by society to transition away from fossil fuels to, carbon neutral or more carbon neutral sources. I think the final one is technology, right? I mean, technology is just playing such a massive role here and has played a massive role here, and it's accelerating, right? The amount of federal money, state money, government money, foundation money, private equity money is and public company money is just enormous, right? And R&D dollars. And so we're seeing the money flow into these alternative technologies, and therefore you're seeing acceleration of technological innovation. But it also comes at you at all angles, right? On the one hand, solar is the most amazing example, right? Every time we or anybody else predicted a 5 or 10-year view of what's the solar cost going to be per kilowatt or what's the penetration of solar, we've been wrong. It's surprising the upside, right? If you look at predictions in 2004, where we'd be in 2020, they 10 or 15 or 20 times off of where we are, right? And the cost just keeps on falling. Now, on a kilowatt hour basis in most markets, solar is the cheapest, right? However, when you look at an integrated system, which takes into the intermittency, the sun doesn't shine, during the day and wind doesn't always blow, and you add batteries or whatever energy storage, depending on the market, that break-even point is not there yet, but will be there, somewhere between 2028 and 2035 in most markets, right? So the first thing is technology, right? The renewables are unstoppable force, and very soon there'll be an economic force, right? They already are in some markets, and with incentives they are. In other markets they're not, but the technology is there and they'll get there, right? So that's one. The other one is, on the other side of the frame, if you look at what our own hydrocarbon industry has done, if we look at fracking and therefore shale gas, there was true technology, digital technology, geosteering, the ability to perform very accurate, long horizontal wells, and then to hydraulically fracture. And if you think about it, in the old days, we just drilled through that shale to the reservoir we wanted. Now all of a sudden, there's 5, 6, 7, 8 layers of shale which can give hydrocarbons. And the transition of the US from short oil and gas to long oil and gas, and this basic ability to provide gas at sub $3 per MMBTU in almost unlimited forms has transformed the economy, and that has massively driven down emissions, right? If you just look on greenhouse gas emissions, the US has been one of the most successful countries on the back of replacing coal via gas. And that is technology that we didn't see 20 years ago, or most of us didn't see 20 years ago.
Or
And
the
simply
application.
starting to see at scale innovation on things like CCUS, carbon capture and storage, and hydrogen. And so I think a lot of these industries that we're writing off for dead are not dead, and they're innovating at scale, right? So that's just one. I'd say just on the broader energy transition, what do we see as McKinsey? We have a reference case. And in our reference case, and these numbers are quite amazing, we peaked on global coal demand in 2014. So, that's peaked, and it's on its way down unstoppably. We believe that we will peak in terms of oil demand in 2029, in a reference case, and in gas in 2037, which puts fossil fuels peaking in 2027, which is 5 years away or 6 years away. It's just remarkable, right? Every time we do these forecasts, we always look slightly aggressive compared to many, not to all, but compared to many. We look, wow, you guys are being too aggressive. And every year, us and other folks have to go and redo our models. And because technology, keeps on pushing this forward. And so we see the peak each time we predict it coming more and more forward, right? Now, what is, that sounds dramatic, a peak of fossil fuels in 27, a peak of oil in 2029. But it still means there's a tremendous amount of oil be needed in 2030, in 2040, in 2050, right? It might have reduced slightly, but the decline is very slow. And so in our reference case, and this is a case that's built up at a microeconomic level, country by country, sector by sector, it's not a top-down scenario. It's very detailed and calibrated with our clients who are in whatever value chain, be it batteries or oil and gas or EVs. So that's our reference case. And again, it's remarkable that we're peaking, but it's also remarkable how much capital is still needed for oil and gas. Because the one thing that's different about oil and gas is the decline rate, right? And so, the amount of capital is still going to be very, very significant going to oil and gas. That said, we have an accelerated transition scenario, right? Which says, what happens if technology actually develops at the kind of pace we're seeing, and we're not too, pessimistic on it? And what happens if some of the regulations that people are claiming they're going to put out there, it is an accelerated case. It's not our base case. But then you see, by, 2050, a further 20% decline, in energy-related CO2 emissions. So base case, sort of 20% or so below the peak. By 2050, in accelerated cases, 40% below. Now, when people see that, they say, wow, that's impossible. And it does make enormous demands. And we can debate about whether the supply chain for batteries and rare earths and these metals we need in EVs can even do it. But we believe it's a possible accelerated case. So people say, what does that mean in terms of temperature? Well, the answer that there would be, if you believe the scientists, still somewhere between 2 and 3 degrees, right? Which many people think would be a disaster. So, when we flip it around and we say, what would you need for a 1.5 degree scenario? So this is not a model scenario. It says, if you want 1.5 degrees, what has to happen? And then, it's pretty dramatic, and you have to do some things that we're not doing quickly. CCUS has to work, right? The circular economy becomes enormously important, right? Reuse of plastics, reuse of materials. Circular, economy just becomes critical. Hydrogen becomes fundamental, right? Because there's a whole bunch of industries that need the intensity, whether it be, steel or ammonia or frankly, even, jets, that need hydrogen. So hydrogen becomes absolutely critical. And we have to accelerate almost everything, be it electric and so forth. So those are our scenarios, and it's, pretty significant.
Could I quickly just underline 2 points that Filipe made? One is on the continued importance of oil and gas in the mix, even though it may plateau or be much reduced, between now and 2050. I think the number that in our reference case models is that by 2040, we're even just to meet a case where you have, peak demand in oil and gas in, later this decade and early the next. Even in that case, which is, debatable and could be aggressive, you would still need something on the order of 38 million barrels a day of replenishment. So we've had to invest to bring that resource back, given the decline rates that Filipe was talking about before. So it's important to remember that part of the story, especially for Houstonians. The second thing I'd underscore in what he was just describing between scenarios is, okay, you have our reference case with, a bottom-up microeconomic view of where could things head in terms of energy mix, in terms of demand, in terms, reasonable assumptions on EV adoption, reasonable assumptions on fuel efficiency, on learning curves and costs, et cetera. That gets us here. Then we do an accelerated case, 20% less emissions, fewer emissions by 2050. But to get to the 1.5 degree scenario, you need a 90% drop. So that's a huge order of magnitude difference. Even off of 20% versus 9% is a huge difference. And Filipe mentioned that one of the big things that would be required to get to that 90% version, which is the 1.5 degree scenario, is circular economy, or put differently, energy efficiency. So some of the things that you would need to get there are going to be growth opportunities for the energy industry, whether it's hydrogen, carbon capture, renewables, and other power generation growth, et cetera. But a huge thing that would be required to get to that scenario is energy efficiency, which is reduced demand. And I think that it's important for people that are participating in that industry in whatever capacity to be thinking about, if this is where things are going to head, either on a market basis or a policy basis, how early do we need to be ahead of that transition? Because it's not slight, it's pretty profound.
Maybe one add to that, we spoke about for 1.5 degrees, you'd need, 90% reduction. I heard a very interesting number from our sustainability colleagues the other day. Now, we all know that policies change, but, and intentions change, and it's easy to say something about the long term. But today, either, announced or about to be announced, we'd say 50 to 60% of the world's GDP is saying we'll be net zero by 2050. So it's easy again to dismiss it. It's 2050, and people just don't know how they're going to get there. And people can debate about even if it's possible.
Magic number. Yeah.
But these are economies like China, like Japan, like Korea, like the whole of Western Europe, and it looks like the administration is starting to move that way as well, right? And so you have 50 or 60% of the GDP saying that's where we want to go. Now we can debate about if it's going to happen, if we know how to get there. But you can start seeing the impact of policy it's going to play on this, right?
We have a question from one of our audience members, from Paresh. He asks, and it's kind of related to what you've just mentioned, Houston is pivoting to lead the global energy transition to a net zero energy future. What do you see as our blind spots or latent opportunities vis-a-vis other energy hubs?
Yeah, so that's fascinating, right? And there's always been a debate about, has Houston diversified, not diversified, and what's the extent of the jobs that is related to hydrocarbons. Some interesting numbers. We are undoubtedly the energy capital of the world, right? I think if we look at, for instance, oil and gas companies, of the 128 public companies, I think 44 of them are here. We're the number one port by volume, and the numbers go on and on. There's no doubt that we've become a more diversified economy. That said, if you look at direct jobs, and that both includes people in the oil and gas value chain, as well as, consultants and lawyers that directly and exclusively serve them, about 25% of Houston's jobs today is oil and gas. However, when you look at induced jobs in the service economy, the doctors, the restaurants that exist to support that, it's another 25, right? So today, 50% of this economy is directly tied to oil and gas. That's number one. Number two is, there has been pressure, and if we look at the cycle of the last 15 years, the industry has not done well from a returns point of view. Obviously, some individual companies have, but on aggregate, it just has not done well. And, some of the numbers I have here is, Houston has lost, just since 2014, I think 190,000 jobs, roughly, call it 200,000 jobs. And we did some modeling, and, you could debate, but depending on the scenario, as soon as 2035, you could lose anywhere from 100,000 jobs more, all the way to well over 500,000, right? So first of all, we are the energy capital of the world. Energy is fundamentally important, even though we're more diversified. And, you know, a fast transition could really, really harm this local economy. That's the first thing, right? Strengths. You know, you know, what is interesting is when we looked at things like, you know, technology companies and so on, you can start those up with often with small amount of money, a handful of people, right? When we look at transitioning the whole energy value chain of the world, you know, and associated industries, these are very, very large capital intensive issues, capital intensive projects, process projects, right? And that's the strength of Houston, right? We have companies that are used to building extraordinary complex projects technologically and environments that are complex, be it pressure or politics. And they're able to deploy capital efficiently. And you know, we have just an enormous amount of STEM and STEM folks and engineers in this. So we have some very, very real strengths. That said, you know, we do have blind spots. I mean, as we said, you know, even in our reference case where you have this peak coming in a few years, more than half the world's energy capital, you know, in 2035 will still be oil and gas or hydrocarbons, right? And therefore, we have the advantages and the challenge of the incumbents, right? Oil and gas is our, you know, our incumbent industry, and so we have blind spots, clearly, you know. The other thing is perceptions of Houston, right? You know, we live in Houston. We see it as this incredibly diverse place, you know, surprisingly harmonious place, you know, food paradise, amazingly innovative. And we know of the green spaces. We have some of the biggest urban parks in the country, right? And we know of all these great things. You know, I think Mayor Turner's done some remarkable things in terms of leading, you know, Houston's position as a green city. That said, you know, perceptions of us and some of them are realities. You know, some people say, you know, when you look at the universities in Houston, we don't have enough, right? How do we compete with, you know, Silicon Valley and California or the Northeast, right? We you know, we have high quality universities, but, you know, do we have enough, you know, student capacity, right? The culture of research and development and startups, right? It's very different here, right? And then there's a perception, right? If we're going to move people and startups and headquarters here to say participate in this transition, people think of us as this big, dirty oil and gas city, not very innovative, and it's very different, right? I will close on that and say we have, I think my instinct is the city's going to rally around and try and remain the energy capital of the world. And I think there's 3 or 4 things where we can be natural winners. You know, and so CCUS, right? We already see our local companies leading the way in many ways, right? With pilots, with investing in startups, with technology plays, right? We have the sources of carbon. We have many sinks, you know, in the reservoirs and so forth. We have pipelines, right? So why shouldn't we lead and win in CCUS, right? Same with hydrogen, right? We have cheap energy. Texas has renewable energy. We have pipelines. We have the processing facilities that need them. And we have the engineering know-how, right? So hydrogen is another fascinating one, right? Why can't we win in circular economy? So I do think there's a lot of places where we can say we can win and lead in those. That said, it's not a done deal. And I think it's a bit of our moment. We can use it or lose it, right?
One kind of related question I'm going to weave into the next one. So how does this transition kind of reshape energy and our geopolitical landscape? And I'm going to throw in a little curve to include one of our audience questions from Rami. Fracking, the impact of fracking, and where do we think that we're going to experience growth outside of the US? So energy, geopolitical landscape, maybe a little bit about growth and fracking outside the US.
Yeah, I mean, look, if you look at fracking, first of all, in the US, right? I mean, there's also another fascinating, and you've seen some recent articles where, you know, big oil companies, not necessarily in the US, have sold assets that are high carbon or have high carbon intensity. And you know, and then you have them off your books and your energy, your carbon intensity goes down. It's fantastic. Is that good or bad for the planet, right? Does the new owner have the capability to operate those efficiently or to reduce the carbon intensity, right? So the first thing we need to debate in a world where if some of the more accelerated transitions come by and we still need a ton of oil and gas, there are still going to be losers, right? Supply losers. And then you say, well, where should we produce this oil and gas? And then you want to produce in a place that is low cost and in a place that has a low greenhouse gas intensity per barrel. And the US actually, you know, it has some phenomenal assets in the Gulf of Mexico, in the Permian, you know, that produce competitive oil and gas, but also low carbon oil and gas, right? So does the Middle East, by the way, right? So when you think about who the last player is standing, it's going to be those folks who can operate and make money in a low price environment or a mid price environment, but also in a low carbon environment. So, you know, I think there's a lot of economic and actually, you know, greenhouse gas reasons why the US should continue to produce and be a leader in oil and gas and including in fracking, right? There's no doubt there's opportunities, you know, for some of the companies who take it less seriously to reduce flaring and so on. But, you know, our bigger and our better well-run companies, both big and small, produce very, very, you know, clean oil and gas. So when we look at the economics of it, you know, we expect, but we don't know, we expect, you know, the frack patch to be a bit more disciplined, but we still see growth, right? It'll take a while to get back to historic levels, but it will get there and it will continue to grow. Not unstoppable, but it will continue to grow. And that could be a whole nother subject.
The discipline will allow for sustained growth. Yeah,
but economically, and when we look at the reservoir, you know, shale in the US will continue to be very important and will grow. The answer is unknown, you know, in the other areas, but what we've found repeatedly is this unique confluence of the geology, the existing infrastructure that we have in the US, and then the sort of capital markets and the technological know-how has been very hard to replicate. So, you know, uncertain if we're going to see, you know, emergence of major, you know, frack basins in other parts of the world. You know, many people predicted it hasn't happened yet, and I think it's very uncertain. So, you know, I think that's that question. When you talk about geopolitics and reshaping flows, you know, this becomes, you know, fascinating. So one example is this, you know, if the new administration aligns around some, you know, targets around energy transition, you know, is this a place where China and the US can cooperate, right? In many other areas, we're competing, right? Naturally so, right? But, you know, could we cooperate there, right? Interesting. I think when people think of geopolitics, they immediately think of oil and gas and then other. And of course, that is important. Energy security has always been critical. And in a world where countries that did not have hydrocarbons or coal can now say, I have an alternative to create energy, of course, that fundamentally changes the geopolitical positions of many countries and the geopolitical importance of many countries. So that's critical. And on the converse, if you look at the electrification and EV market, you know, there's 2 or 3 raw materials that are just fundamental, right? So rare earths, right? We know that China, you know, produces the bulk of these and also has a technological advantage on how to refine these rare earths efficiently, which other countries do not have. And so there's going to be a race for not only rare earths, but to create the ability to, as efficiently as China, process them. And these are fundamental, you know, to the magnets that power the electric motors, you know, that we need. So rare earths is a big deal. Another one are things like nickel and cobalt, especially, right? Grade A nickel that we need is becoming harder and harder to find. And so nickel is going to become critical, right? We all know the challenges of cobalt, right? A big percentage of it occurs in Central Africa, and the conditions which they're mined are unacceptable, right? In many cases. And so some countries are going to become more important than others as they reorient. But I think where the real geopolitical changes are going to be are trade flows, right? So there's a world emerging where policy can say, you know, we are going to have carbon tax at borders, right? And that's going to fundamentally change, you know, both economic constructs of, you know, who's cooperating and who's competing, but also will change flows, right? And so I think a world where there'll be a carbon number and even potentially a temperature on every company and product and you start getting border adjusted taxes for carbon, that's going to change trade flows, right? And that's going to change geopolitics. So, you know, some points there, but I'm sure Nikhil has some perspectives there.
Well, my prior life, it wasn't part of my bio, it was in foreign policy, but I have to restrain my urge to talk about every detail of it. The one thing I'd add, just on top of what Filipe described, is when we think about the oil and gas dependent states, so the ones where, you know, state economy and the government is dependent on royalties from oil and gas production and sale, I think the key thing is the energy transition isn't sneaking up on anybody. So everybody knows it's coming and something has to happen. And you see state governments using sovereign wealth funds and other vehicles to try to figure out, how do we take the money that's coming in now from oil and gas and use that to potentially reposition the future of the economy and diversify? You see the same types of early actions by NOCs, whether it's Middle East, Southeast Asia, other parts of the world, to start getting ahead of the change that's happening. But I think the real logjam is going to be around pace. So it's not just that we see the energy transition coming. To what extent, number one, are these governments and state companies making the right assumptions about the pace of change, or at least making decisions based on uncertainty? It could be linear, it could be long, or it could be really fast and a hockey stick in terms of, you know, demand shifting, for example. And so are they making the right bets there? And I think the second thing is, can they get over bureaucratic inertia? I mean, in some cases, the whole government structure has been wound up over the past 70 years or whatever the right number is around the oil and gas economy. And so there may be a bureaucratic government structure element that constrains pace to a degree that, you know, without some kind of profound attempt to change it, won't allow them to move fast enough versus what's happening in the world at large. And so who knows how that'll play out.
And I won't pretend to know the outcome, and I definitely won't speculate the outcome, but you hear different pundits now talk about what's the role of OPEC going to be, right? We saw in this crisis, OPEC came together and played a remarkable role in stabilizing the market. And so some folks will say it's going to become even more important in this complex world. Others would look at it and say is, in a world of flat to declining demand and prices come down, you might get a serious tension in OPEC, because there are folks in the Middle East that are going to be the last people standing, right? They have very competitive oil and gas assets and companies, and they're low cost, and actually they're low carbon as well, right? And then you have a whole bunch of others, including some in West Africa and so forth, that are fundamentally higher cost and not as clean just because of the geology. And therefore, you know, you could create some tensions. And so some people say, will OPEC survive, or will it survive in its current form, right? So I think in every sector and every fashion, you start seeing these things, you know, align. You know, the race for batteries, who's going to own the battery supply chain, right? Is it going to be a global one, or is it going to be one or two countries that totally own this, right? So I think you're starting to see a lot of questions. And that's where COVID comes into this as well, right? We saw countries all around the world start saying, you know, but what about my security of supply of medicine, of PPE, of vaccines, of computer chips, right? And so all of a sudden you start getting states being a little bit more interventionist, right? And so it's a fascinating world we live in now.
It is quite fascinating. We have abruptly changed every way that we're doing things. And Nikhil, you spoke about the change of pace. Certainly we have moved to a more digital environment. Let's talk about that digital environment and reskilling. Could you tell us a little bit about what is reskilling and why it's so important?
Yep. There's so many definitions out there, but the simple one I'll use is it's the idea of helping individuals to build on the skills they have, add new skills that allow them to move into a different set, an expanded set, ideally an improving set of job opportunities, right? So there's skilling and just building the skills, upskilling where you stay in the same line of work, but get the training to be able to do a higher value added task, expand the nature of what you're able to do in that job, and then reskilling, which is by far the hardest of them all. Maybe that's arguable actually, but it's one of the hardest. And this is about gaining skills that give you more options to pivot and move into new jobs, new sectors, ideally with economic mobility attached. And, I would say for myself, and I think, we as a firm are seeing the importance of reskilling. I would say that it is fun. This is me speaking for myself. It's fundamental to the future competitiveness of the US economy in the global economy. And it's fundamentally important at home for equity. So if we look, our colleagues at the McKinsey Global Institute have done a kind of a progression of analysis on the effects of automation and offshoring on jobs, on work activities, and the future of work, both in the US and globally. And if I take the US perspective, something like 1/3 of the workforce of the US workforce may need to make some kind of job transition between now and 2030. That's on the higher end, right? And this is driven by the fact that something like 60% of the occupations in the economy are around 30% automatable. Because to understand automation, you have to break it into the work activity. So 60% of the occupations, 30% automatable. That's a big chunk of the work that's being done in the economy today. Obviously, there are a bunch of things that slow the pace of that move toward automation. But you could still see something on the order of 75 million people needing to actually move, or not, that may be, jobs, occupations that are getting automated. So it's a huge number, and it's sooner rather than later. 2030, we're already in, it's 2021, and 2030 is not that far away from a labor force perspective. It's going to be crucially important for us to be able to deploy and tap into all of the amazing talent that exists within the US labor force, expand the opportunities for Americans to be able to draw on that talent in the occupations that are growing, and do it in a way that it's more and more inclusive. So more and more Americans, including Black Americans, Latino Americans, people without 4-year degrees, women, are able to be more and more a part of the benefits of the change and not just feel the brunt of it.
And I think we've all learned that the pandemic has accelerated the need to reskill. In what ways has the pandemic maybe worked against us?
Well, I think it's a pretty simple answer, which is that it's done a couple things. One is it's really exacerbated the challenge ahead of us because there are so many people now that are unemployed that need to find work in an economy that could recover fairly slowly depending on the success of policy initiatives and spending plans. And even then, there's a recent report, and I don't want to get the numbers wrong, but our MGI colleagues put out a report on what different scenarios of the pace of the recovery from the pandemic could be economically. And people without a 4-year degree, it could be not until, in lower wage jobs, it could be not until 2025 before they get back to 2019 levels of employment. So the pandemic has really exacerbated some existing inequalities and challenges for the workforce. The other thing I would say is that it's not just exacerbated the challenge in terms of economic opportunity, but also the inequity associated with that. So if you look at who has been most affected in terms of job losses, it's ethnic minorities, it's women, it's exactly the same population that was under duress in the longer term trends and pre-pandemic. So it's intensified that. The last thing I'll say on this point, one other factor the pandemic has really intensified is in certain sectors and certain occupations, it's accelerated the automation trends. And we have not to over invoke MGI, but they do great research, so I will. They just in February came out with an updated view of how much of the workforce may need to make a transition due to automation based on what we could see coming out of the pandemic. So for example, looking at what are executives saying, something like 2/3 of executives are saying there's going to be really increased investment in automation across sectors, looking at the nature of the work in different sectors. And so you see, I gave you a number before on how much of the workforce in the US might need to make a transition by 2030. That number could go up by 25%. Meaning not up to 50%, but 25% more Americans might need to make a transition because of accelerated automation. And we also may see a different, even tougher effect across wage bands. To be more specific, when we first looked at automation, a few years ago, we thought the effects would be wage polarization, meaning that there's going to be growth in higher wage jobs in STEM and healthcare, et cetera, and potential growth or at least sustenance of some of the lower wage jobs that weren't in predictable environments. So they're harder to automate, but they were lower wage. So this is gardening and plumbing and a range of other, other types of work. So a lot of the middle wage jobs, like in production operations in a predictable environment, were the ones that would be hit the most. Thanks to the effects of the pandemic, we anticipate that a lot of those lower wage occupations that we thought would be harder to automate or would take longer are actually likely to be part of that automation story earlier within the decade. And so you get the picture. It makes the importance of reskilling and expanding opportunity for people just that much more intense.
I know we're getting close to time. There's so many questions I have around all of these topics, but what do you see the face of the workplace looking like? What does the work environment look like after we've reskilled?
Well, I think you'll see a lot more representation across, if we do it right. This is not automatic and it depends on the way we take action. But if we're smart about it, you could see a lot more representation of Americans across wage groups, meaning across all of the jobs in the economy. One of the major efforts McKinsey is a part of is called the Rework America Alliance, which was convened by the Markle Foundation, includes 30 different institutions that cover the whole gamut of the workforce development ecosystem, big employers, Federal Reserve, unions, advocacy groups, the whole range, community organizations like the Urban League, all have come together to try to expand opportunities for job seekers based on their skills and experience and talent, not just degrees, although we want to expand opportunities for that population of Americans too. And one of the things that is central to the efforts of this alliance is how do we find opportunities for people to move to next jobs that are good jobs, ideally better jobs than what they were coming from, and see if we can start in very tactical ways getting at the barriers that have led to unequal representation and access to those jobs. So, if we look at what we're calling origin jobs, where you have a lot of unemployment, there are a lot that also represents a lot of Black Americans, Latinx Americans, women. And when we go into target jobs, which are higher wage, above 42,000 annual income, resilient to automation and offshoring, the representation really drops. But on a skills basis, those jobs could be accessible with targeted interventions and support. So how can we as a workforce ecosystem and stakeholders that are interested in expanding opportunity help to this huge millions of Americans, huge number of people, harness their skills and access those jobs, which they have the ability to do with some support?
Maybe to round that out a little bit, if we look at all these global forces going on, it's easy to say, wow, there's so much change, there's so many challenges, and get a bit pessimistic. I'm enormously optimistic. This is a personal view, right? As a recent immigrant to the US and to Houston, I moved here 9 years ago.
He got his cowboy hat within year one.
Exactly. But this economy is remarkably resilient. It's remarkably dynamic and innovative, right? What other economy in the world can create and capitalize something like SpaceX or Tesla, or if we look at all the vaccine successes around the world, so many of them have been driven out of the US, right? And so, whether I zoom down and I look at Houston or whether I look at the US, I'm very optimistic. There's enormous challenges, but with challenges, first of all, we shouldn't be scared of technology and productivity. In the end, there's winners and losers, but society tends to win, right? So the question is, how do we make sure we win? We maximize that win, and it's as equitable as possible, and we use it to, redistribute any imbalances that we have. But in the end, America wins when there's technology and change, right? And so does Houston, right? We have a lot of capital, a lot of STEM, dynamic capitalism. And so I'm hugely positive, and I believe that, we'll look back and we'll say this is going to be a decade of just unbelievable change, but we might all, emerge out as winners in this. And that's, my hope and prayers for us all.
Filipe, Nikhil, thank you so much for coming on the program today, sharing your and McKinsey's thoughts. We so appreciate it. Thank you very much. And
Thanks for the opportunity.
Thank you. Thank you. I want to invite all of you who are watching to make sure you tune in for our programs upcoming in the next week or so with former speaker John Boehner, the CEO of Weatherford, and also our exclusive program with the president of the World Economic Forum. I want to thank our gentlemen. Thank you again so much for joining Global Connections and the Council today. To everyone, have a great afternoon, fabulous weekend, stay safe, stay healthy. Bye.
Thank you.